We begin with the morning brief, and we're talking momentum here this morning. This is something we also talked about with Jared Woodard of Bank of America a little while ago. When stocks rise in the first half of the year, they tend to keep going up. And even though, as we discussed with Tony Dwyer yesterday, there was some turmoil under the surface in terms of rotation happening rapidly, overall, that has been historically the trend, Myles, that we have seen, and a number of folks have been pointing that out.
Yeah, and Jared's note had some similar numbers to this, but the work that we went off for the morning brief today came from Bespoke Investment Group, and we'll kind of lay out the nitty gritty, and then we can get into maybe the bigger picture here. So Bespoke looked at years for the S&P 500 that were most correlated to the performance we've seen so far this year. So not just how much the market has gone up, but the way it went up, the volatility, essentially what the line on the chart looks like this year, and found the 10 years that were most similar. Well, in those 10 years, the average gain for the S&P through July 14th, when they published this note, was 20%, and the median return was 18.8%. So through Thursday's close, the S&P 500 is up 16.1%. So we're pretty much, right in the mix there. And when you take those years that look most similar to 2021, the median performance for the S&P over the balance of the year is a gain of 7.1%. And the market is higher over that period, 70% of the time. Now, for all years for the S&P 500 since 1928, the median gain for the index over the second half of the year is 4%. So again, you're looking at 3 percentage points of outperformance relative to how the market typically performs in the second half in years that look like this year. All of which is to say, history very much on the market side. And the final point that their data, I think, really makes that is perhaps most pertinent to the conversation where we've had over the last few weeks, where you're, especially to Tony's comments about this rolling correction, the median decline for the market in those that look similar to 2021, the median decline for the market over the second half is a mere 2.3%, and only twice has the market in these years corrected more than 10% at any one point, peak to trough. So another marker of this kind of environment is very low volatility, at least at the index level. And as we discussed in the brief today, underneath the surface, it is very much not a stable situation, right? You've seen that forceful rotation back into growth, out of value, outperforming sectors like industrials, materials, financials that were outperforming the S&P 500 on a relative basis. They've given up all of that relative outperformance and are now relative underperformers to the index this year. So, and as Tony outlined in his conversation with us on the program, he said, everybody got on one side of the boat last August. It was, it's the reopening trade. Then everybody gets on the cyclical trade the beginning of this year. And that, those trades worked for a little while, but the speed with which the market, kind of bailed out of those and into another style, I mean, that's left, some people with their heads spinning. And so I would surmise, I would argue, and I didn't make this in the piece. I think it's more of a conversation, here rather than something you're going to report out. But I would argue that these kinds of environments where the index goes up a lot, the index has very little volatility, are typically marked with underneath the surface rotation because, when you have 500 constituents, very rarely are they all moving in the same direction at the same time. And we can go through the exercise of whether it's good or bad that FANG leads the way, but that just is what it is right now, right? Those companies have the most market cap, and because they have the most market cap, they are propelling the index, to highs, and today pretty much trading at a record level.
Myles, it never ceases to amaze me, the opposing views sometimes in the markets. Here we have Tony Dwyer, very respected strategist. He's talking about rolling corrections and stocks underneath the surface not doing too well. I have a new piece on Yahoo Finance looking at the underperformance of the small cap Russell 2000 over the past few months. And then you have Jared Woodard really saying things look great. I guess that's what makes a market, right?
Well, I would say I think you guys are all saying the same thing, though. Like, part of a market in which you have rolling corrections, in which you have styles, falling out of bed, as everyone hates small caps all of a sudden, right? Everyone loves Apple all of a sudden. I mean, that is a part of a market that at an index level, at an S&P 500 level, which is where, we are typically looking when we say the market, things remain positive because you just mean, like I said, you're never going to have all 500 members moving in concert where, oh, everybody's rallying all at the same time, right? It's styles, it's preferences, it's size factor, it's, which companies are growing earnings the fastest. Parts of the market do their leading at various points in time. And I think what we're all discussing here is who's leading today, who used to lead, but what does it net out to? What it net outs to is the S&P going higher in general, right? Broadly, that's the direction the market has taken this year. But I don't think that there's been quite a bit of pain along the way. And maybe a better way to think about it is 2015's market. Market was flat for the whole year, and underneath what the average stock I think lost 30% that year. I mean, that sounds like a bear market to me, but you still had the S&P flat, and so it's the same dynamic as that, just a little bit more fun, right? Because everybody's making a little bit more money.